Hey, it's Phil Wade from Dalton Wade Real Estate Group, and today I'm joined with Talia,
Hello.
Claren, who's a little under the weather, but able to hold the camera. So, hey, thanks for tuning in. Today we're going to talk about the buyer's loan commitment and kind of how that ties into the financing contingency. So there still seems to be a little bit of misunderstanding. We've gone over this subject kind of numerous times, but um, not sure it's completely sunk in with anybody. But so let's start with the loan commitment. What is the loan commitment? Claren, do you know what it is?
This is actually funny because I just had to get a loan commitment a couple days ago, and the lender doesn't do loan commitments. So they're like, what do you want me to write on it? And I was like it's clear to close. And she's like, well, it's not. There's a couple items left. And I really didn't know exactly what to write, so I did my best, and the seller ended up accepting it. But I need to know exactly what needs to be on it. So this is a good one for me to be on.
Cool. So that's yeah. I mean that is something we were going to touch on if the lender doesn't the lender doesn't give a loan commitment, which some don't. TD Bank is a lender that I know doesn't do that. So for me that's problematic. But so the loan commitment is a formal letter from the mortgage company or the lender, the bank, stating that the borrower has gotten the loan. And then there will be some boilerplate language that allows the lender to get out of it if certain things happen. But again, those are sort of 1 in 1,000, so that doesn't really ever happen. But you'll see that. But so what you want is a clean loan commitment that doesn't have any exceptions. There usually are exceptions. So I just had a financing contingency come, to the end, a buyer I'm helping. So what was on her loan commitment? There were two things. One, that she was short on the closing funds, so she needed a gift from her parents or someone to kind of make up that difference, and the lender needed to see that. The second was that she needed insurance. So let's talk kind of about those two items. So she's very, very confident on both. And in fact, what ended up happening on the gift money was that the lender then recalculated the closing costs, and in fact, she had enough money, so that got removed. And then she got insurance, so that got removed. So then basically, she's got a clean loan commitment. The lender's telling her everything's in order. We're not closing until November 18th. So, but everything is there. We're good to go. We don't have to ask for an extension on the financing. So sometimes, if you get you always want to be asking for the loan commitment. So I asked for that loan commitment a week before the financing was ending. So I was on top of it well in advance, just so you're not waiting for the last day and then all of a sudden, there's something there that becomes an issue. So we were able to resolve those things in that week time. All is good. But what are some things maybe that might be on the loan commitment that would give you concern? The appraisal's not back. The tax transcripts aren't back. It's not been fully underwritten. Again, if you get some slightly higher end buyers, they have more complicated financial pictures. So maybe the lender's still waiting for something. But it's not, and if that something comes back and there's a problem, then maybe they don't get the loan. So you want to be, in consultation both with the lender and your client in terms of, okay, how difficult, or not is this? If it's not, then, you're probably good to go. If it's the appraisal, again, who knows what that's coming in at. So if you just kind of let that go by and you kind of hung your client out there, it could be a problem if it came in, and then they didn't have the funds, came in low and they didn't have the funds to make up. So so the loan commitment tells you your buyer has got the loan, or there's still things the underwriter lender's working on, and then you have to have that conversation with your buyer, with me, But ultimately with your buyer, like, okay, what are we thinking here? What are we doing? Are we good with how it's written and we feel confident that, you know, we're going to get the loan, or do we need to ask for an extension to have those, you know, extension of the financing and maybe the closing, you know, to make sure that those, you know, conditions are met. So, you know, so there's two types of exceptions. One, you know, a lot of times you'll see, you know, they need to verify employment. You know, that'll be on there. So a week before, a few days before closing, they're gonna call. You know, they may rerun the person's credit, you know, a few days before. You know, oh, have you bought anything large, especially if they have like tight debt to income ratios. But, you know, so hopefully none of those trigger any problems. But, and again, those are things you can't help. All you're doing is kind of advising your client. So there's ones that you're, you know, 99% certain are resolvable, and then there's other ones that maybe, you know, as I said, the appraisal, maybe the thing isn't fully underwritten, you know, who knows? But you got to look and see, and then if, you know, ask me, call me, and then we'll talk, you know, you'll talk with your client. So where ultimately you want to go, the other thing is, you know, you've got the clear to close. So, you know, lenders don't issue the clear to close typically until they're ready to close. So, you know, certainly, you know, it's always best to have the clear to close, because then you know it's really a done deal. But kind of the way the contract reads, where you need the loan commitment, you know, 7 days before, you know, the closing, you know, you need to get that, and you want to be asking for it, you know, sooner than the last day. And it's surprising to me the number of lenders out there that just, they don't really care about, you know, the person's financing contingency. They don't think like that. They just are trying to get that thing processed. So, you know, we need to be, you know, on, you know, on top of that. And then how that ties in, you know, to the financing contingency is very simple. You know, if it looks from the loan commitment, they've got the loan, you know, prior to when the financing contingency is expiring, then, you know, they're good to go. If not, then, you know, you've got to ask the lender, like, how certain are you that you're going to be able to close on time? You got to talk with your client, talk with me, and then you've got to make a decision, you know, how you want to proceed. Do you want to ask for an extension so that some of those exceptions can be cleared up? Or do you want to tell, you know, maybe back out because there's stuff that looks very, very difficult, it doesn't look like it's going to happen, or you know, or just proceed on and, you know, hope that what's there is minor and you're able to close on time. You know, as we talked a little bit, some lenders don't issue a commitment letter, so it makes it harder. Like TD Bank, as an example, they don't issue a formal commitment letter. That's the bank's policy. Now, they're not going to give you anything that tells you. I mean, you can talk to the lender, they can tell you what's still open. Obviously, it's a big bank, you know, the person you're dealing with, you know, needs to talk to underwriting, so it's a little less formal and consequently a little bit more shaky. So again, you don't want to be waiting till the last day because maybe you don't get in touch with the person, then what do? You want to find this out, you know, well in advance. And personally for me, like, I wouldn't use TD Bank because of that, because I don't want to, you know, have that situation where, you know, I don't have it formally documented. So that's kind of how that ties in. So any questions? Kaya, any questions?
Yeah.
Claren?
Nope.
Anybody, any questions in Periscope land?
Someone said, Phil is right. Watch out for income verifications in the exemptions. It should be done at this stage. So that wasn't a question, it was a statement.
Yeah, I mean, I think again, you know, let's go back to, you know, even go back further from the loan commitment and talk about the pre-approval. Okay, so basically, you know, we had a couple weeks ago, Jim and Daniel in from MI Mortgage.
That is Daniel.
Oh, right. So, hey, Daniel. You know, they issue a very strong pre-approval. They've checked the income and asset you know, they've done that work so that, you know, and the advantage of that is several. One, they can tell you, okay, how tight is your buyer, in terms of debt to income. If they're tight, then you got to watch out for things like flood insurance, high taxes. If they're getting a condo, because extra $100 might flip them over, so that now their debt to income ratios, don't work.
Someone asked what was the name of the bank that you did not want to use, and here, if you can turn around. It was a TD Bank, and I've actually used them a few times, and it's gone fine for me. And what they will just do for me is just the loan officer will send me an email saying that they're clears to close without certain exceptions, but it's all good to go. And that's always been fine for my sellers, whoever that is for the listing agent. But yeah, they don't have a formal letter, but I haven't had a problem yet with the email that listed out.
Yeah, I mean the email is fine. It's again whether it's formal or not formal. It's just that you just need to know. I mean you got to be on top of that. I mean it ties into the financing contingency. Your buyer has money at risk. They're counting on you to they don't understand this. I mean a lot of agents don't understand it. So that's why we've had this kind of same training numerous times, because I keep getting questions and situations that like so it's time to do another training. So but again, it's really quite simple. It's whatever date that financing needs to be in place, you got to be finding out okay, Mr. Lender, what's left to do to be able to say this person is 100% good to go. I mean, it can never really be 100% because the world could crash and they might not get the loan. But in everything being normal, you want to know they're good to go. And if they're not good to go, what is still left to do to be able to get them to good to go? And then if there's stuff left to do, what is that stuff, and how likely is it that it could become a problem? And again, you want to shift. Your job is not to decide, oh, it's a problem. It's in conjunction with your client. You are advising your client that, hey, we're here and we have this. For me, I mean, it was a week ago. I'm talking with my client. Okay, are these two things, the insurance and the gift money from your parents, are those easily done? And she said they are. So we're good to go. And so then if something happened, I've done my job. I didn't then forget about it and let her hang out there with those two things, and then there's a problem. So again, it's not your decision, it's your client's decision. But they don't know this is coming up. They just think, oh, I'm getting the loan or not, or I'm going to get my money back. That's where your responsibility kind of comes into into place. Anybody else with any questions out there?
What type of insurance is that?
It was their homeowner's insurance. So basically, when someone's getting a loan, because the bank is using the home as their collateral, there has to be insurance on the home. So, for instance, if you had an issue with the 4-point inspection, and there's issues with that, and those issues are causing problems for the person getting the insurance. If they can't get the house insured, they're not getting the loan. So if insurance is a big thing, so again, a week before that, you'd want to be calling, or your client calling, or both calling, because some carriers will do it, some won't. I mean, a lot of times you'll have galvanized plumbing. There might be an insurance company carrier that won't insure with that. Maybe there's an issue with the roof. There's all various situations, but sometimes they'll insure, but then it has to be fixed, within 30 days after closing. So again, but it's their homeowner's insurance. Without homeowner's insurance, protecting the bank's collateral, they can't get the loan. Alrighty, thank you for tuning in. We'll have another interesting subject next week.